All right, everybody. Hello, and welcome to episode number 2 of Investors Mindset Podcast. So my name is James Pope, and I have here with me Shane Haig and Reggie McFadden. And today we want to discuss preparing for the next financial investment storm. We aren't forecasting it, but in our experience, when you start to think about the next storm, your mind flips suddenly from return oriented to risk oriented. And so that's the things we want to talk about today is kind of some risk management steps, both on the investment strategy, philosophy side and on the financial side. And so this is a old topic actually from a This and That years ago that is one of them that seems to never get old, and we can bring it up from time to time and talk about new events that are happening with the market and tax changes as well. So let's just go ahead and get started here. First, I'll just ask if y'all want to add anything before we get started. But my plan was, got a few questions to ask y'all and just kind of get your response. Anything before we get started?
No, I think we're good. We did a little video on it once years ago too. That's probably on our website, buried somewhere, but I don't have anything to do. I'm just glad we looked at the questions at least a few hours.
Right. Hey, we're improving already. Episode number 2. All right. Well, I'll start with you, Shane, and then Reggie can jump in on this one too. But how does maintaining a low withdrawal rate reduce the risk? And what do we mean by withdrawal rate?
Typically, that's what the retiree is taking out, for living expenses. To me, it lessens the chance you have to sell something when you don't want to, if you have a low withdrawal rate risk, such as stocks in a bad market or correction, kind of like the COVID April or March 19, those lows would have been terrible if you had to sell because you had a high withdrawal rate or something like that. I also think that having a low withdrawal rate allows you not to feel like you have to time the market. So if you had a low withdrawal rate and several years of planned withdrawals and cash, CDs, treasuries, that type of thing there, you don't have to try to do anything when the inevitable market swoons come our way. We know they will, but you'll have time on your side, and we really want time on our side. I also think it just gives you room for error. A high withdrawal rate's risky for someone who might have several decades in front of them and minimizes that room for error. But I really think of it the way a retiree, an engineer, told me that his father told him, who his dad flew remote controlled airplanes, and he said, "Son, always fly 3 mistakes high." And I think that's a perfect analogy to it. The last thing I think is that the low withdrawal rate increases the odds for a more successful outcome, or the opposite is that a higher withdrawal rate increases the odds for lower investment returns. And I think that's true because inevitably it will force the money managers to have to rebalance more quickly than they would like to, or sell investments that they otherwise wouldn't be selling for other people just to replenish cash for that high withdrawal rate. So for all those reasons, I think clearly a low withdrawal rate, it just reduces the risk.
All right. Anything on that one, Reggie? Anything to add there?
Well, no, I think it also, just as far as withdrawal rate goes, if like Shane said, it increases your chances of success, as well as allocations. I mean, for many years, cash has been zero. Bonds yield next to nothing, and investments obviously have done well in the past, but even if you look over historically, you give them a long enough time frame and your odds of success go up substantially. And then back to Shane's point, back in, when we think of kind of the fixed maturity and the to go along with the withdrawal rate, is having that cash there, while yes, the yields are zero, you're losing to inflation, but it also gives you the mindset of an investor, as well as just creating that right environment to lengthen your time horizon and increase the chances of success for an investment. I think that's really key, is really getting the correct environment right.
All right. Well, you brought up, fixed maturity. Separate that from investments, meaning investments that don't mature. What we kind of put here, you need an appropriate allocation towards that. Really talking about a retiree. So what would an appropriate amount be, in your opinion?
It basically depends on the investment environment. While the stock prices are high and cash is low, so you really have to kind of gauge what kind of environment you're in. If yields were higher, you could easily have more allocated towards that because you're getting the cash flows. We like to say 3 to 5 years. It depends really kind of in everybody's circumstance, but 3 to 5 years is usually that range. 5 is probably a little bit long, just because of the low yields.
All right, Shane, anything to add toward that? Speaking about the appropriate allocation towards fixed maturity.
I think we've been pretty consistent for a long time there, and even though yields are what they are, you still need it. To me, it's the first level of defense. So when I know I've got that 3, at least probably 4 or 5 in place, then I've got the appropriate mindset, like Reggie was saying, I think, where you can be an investor with the other assets like that. And at some point in time, interest rates will change, like Reggie said, and there might be rational decision making where you increase that or make changes. But right now, nothing changing there, in my opinion.
I think this is the great example of where, how I began this, talking about when we start discussing the next storm, your mind goes to risk. And so it sounds like basically what we're saying is fixed maturity, it still has a low interest rate. It's your hedge against volatility of the investments, which we know is inevitable at some time. We just don't know when.
Right.
And I think, one quick thing is, we talk about investments, and everybody obviously first your mind goes to stocks, but even if you had a bond ETF or a high yield bonds, I mean, even just the aggregate bond index in March of 2020 was down 10%. So while cash is zero, it doesn't fluctuate. And so take low yields on the aggregate bond index, along with the fluctuation in March of 2020 and down 10%. I mean, that's a shock, because everybody says when stocks go down, bonds are supposed to go up, and you're starting from such a low interest rate point here that you could find yourself in a scenario where bonds and stocks go down at the same time. I mean, I know people don't believe that, but it does happen.
Okay.
Yeah, I think, and you're adding a little point to this distinction here, and that one of the benefits is just the investor's mindset, knowing that you have something that comes to an end, fixed maturity. And what you're describing is when that market goes down, because inside of AGG are a whole bunch of fixed maturity things, except for that aggregate bond index is not fixed maturity itself. It just invests in these. But if you have it separated, the client, the end investor, knows that there's a deadline here, that is actually a contract based or for the person who issued the bond has to repay you at that time. And that is much different than what you're describing, the open-ended investments, where it's mainly on the investor to decide when they're going to end the relationship. So now I have a question about the kind of the flip side of that is when you take out debt yourself, and obviously interest rates are low now, house mortgages, prices of cars went up, and then associated with that are, loans on the cars. But how do we keep, and what should we think of as appropriate debt levels to maintain? I'll start with Shane.
Personally, I think the high debt, especially in conjunction with a storm, and that's kind of what we're talking about here, puts a lot of pressure on people. So I've seen more bad decisions or less than desirable outcomes happen when you put those two together, because sometimes I've seen people where they're understandably fearful, as have I been through some of these storms, but they might just say, oh, I'm going to pay off my entire house, and they blow 30 to 40% in taxes. They don't have the future investment returns on that money. And so that large debt and the decision with that ended up, in hindsight, being a pretty poor one in the future. And so I think you got to be really, really careful, especially as a retiree. I mean, that's not to say reasonable debt at these low interest rates can't be favorable in some situations. And I've worked with many people where we did integrate that, but typically those people were pretty well balanced, and their additional cash flow from the debt was satisfied with a modest withdrawal rate. So they didn't have to withdraw, make that adjustment. And so that was favorable in those situations. But, in general, I mean, high debt's tough enough in your 30s, and it doesn't get any easier when you're a retiree.
All right, Reggie, anything on that question? Debt levels?
Really, Shane hit it. There's a balance because the low interest rates do give some opportunity for investment to actually have the asset or whatever it is that you go into debt for. But it's just about keeping it flexible and keeping it manageable.
Okay. I'll go on to the next question or the next point we had, and this actually probably is outside of finance and investing and more along the lines of social issues and personality. But we often have, retirees, and then it's kind of a group. You got the new retirees where all of a sudden you cut off a paycheck, and that brings, some anxiety. And then, of course, you have older ones. So I think I was writing this one thinking about the newer retirees and basically not burning bridges, maintaining work skills, maintaining work contacts. We've seen times when people go back to, not as an employee, but doing basically a specific project. And anything you can add to that, Shane?
Sure. Always fly 3 mistakes high. I mean, why not? It's, and good point. Somebody thinking about retiring in 5 years is different than our 15-year retired veterans, but the other part of it maybe socially is that not everybody enjoys retirement like they thought they would. Some learn afterwards that they really miss work, and they're happy staying busy that way. And so by having that relationship and those skills and keeping up to date with them is beneficial socially. Financially, the extra income, it can allow less withdrawals from the retirement account if you are in a storm, so to speak. So it's making it easier for the extenuation of the accounts, I think, is really important. It could allow somebody to defer taking Social Security if they're working, and allow that Social Security to grow more and more and more for them and possibly their spouse. But I'd say the last thing maybe on my mind on that subject would be that maybe that extra income also is less pressure for somebody, and it could lead to more rational decision making if you do encounter or whenever the next storm is coming.
I kind of add on to that. I keep going back to it, and maybe because I do think it's of importance is really maintaining that flexibility, because obviously the future returns are unknown and the sequence of returns are unknown. So that flexibility in your personal situation allows you to navigate the seas much better than somebody that only has one option and one out. So I keep saying it, but to me, in the unknown investment world, is really maintaining flexibility, and it's so key and allows you to do and handle many more situations that come your way.
That's a great lead to the next one. This is the complete opposite of flexibility. We say don't put all your eggs in one single basket. Now that's an old one, and I'll start with you, Reg. It's kind of a continuation of what you were talking about there. But
right, the first thing everybody thinks of when you throw out "don't put your eggs in one basket" is diversification. And while it is key, I think it gets overused a lot. You could sit there and say, well, S&P 500 has 500 companies. It's diversified, right? Well, it's really one position in a portfolio, and at the same time, even if you go through it, the top 7 stocks make up 27% of the 500, and they're all in large cap tech. So while it's a diversified tool, and you could sit there and stand behind and say, well, it's 500 companies, it's got to be diversified. If you look at really the top weighting, 27% are in 7 companies, so that leaves 73% out of the next 493. And that's, to me, why diversification gets overused, and a way to, for me, from a risk management perspective, and is really to build it around your specific situation, not what your neighbor's situation is, not what textbooks say or the talking heads on TV, but you specifically, and to really focus on your situation and knowing, not everybody else's and what they're saying on TV.
All right. I think it's Shane, your turn.
To me, when I think about that one, I agree with everything Reggie said, obviously, but I think of people typically who got into a situation because they worked for the same employer for 35 years, and I remember back the Enron collapse, and they had the employee meetings, these big forums that were taped, and they're saying, somebody asked the question, should I put everything in Enron stock? And the officers even encouraged it, and so then, of course, if you think about it, I'm sure if somebody worked at GE for 35 years and they had all those incentives to have that, you just get to be vulnerable if you have a lot in just any one company stock, and that would be true of any one bond or anything else. And so that's kind of what comes to first mind when I think about those things. And if you just can't play any defense or do anything if you just had it all in one company or something like that. So
right,
it's just the basics, kind of common sense. I like to concentrate in good investment ideas. I don't mind having a fair share of something, that just not to having so much that you can't manipulate, work around it, where you're just totally stuck with whatever that does.
Well, I kind of hear a combination between you two, and flip it on its head. The worst thing you could possibly do is be severely concentrated in something that you don't know any about what's going on. So that would have to be, the most vulnerable position for an investor to be in, is something, even if, like Reggie said, underlying it has 500 stocks, but you don't know what the allocation is, or like you described, hey, you're working for this company, but you don't really know what the books are for Enron, and you don't have any skill in analyzing that. You're reliant upon somebody else's word,
Right.
And so I think that's a good one it's easily accomplished to just avoid putting everything in one basket. Now the next one, we kind of go to some investment strategy or philosophy, but it's really what we have here is one way to avoid getting, I guess, destroyed by a storm is to focus on patience and risk management before just going out there and saying, oh boy, this one can make me a lot of money. So I know that's kind of in your wheelhouse, so I'll start with Reggie.
Right. I mean, it is flipped on its head. The key to high returns is not losing. It's not necessarily getting the highest return. And you know, the reality is, if you think of things go down 25%, it takes 33% to get back to break even. If it goes down 50%, you got to get 100% return from there to get back to break even. And it gets lost on, and you know, everybody's thinking 100%. Golly, I mean, you would love to have just one of those. So if you could just focus on not losing, the returns take care of themselves if you've done the analysis and can actually hold through it. So I think the risk part of it is decision number one and should be focused on first before worrying about what kind of return you're going to get.
All right, Shane, anything to add?
No, I thought bingo.
Yeah, that's pretty good, Reggie. On to another concept of ours, not ours exclusively, but to focus on value analysis over popularity analysis. Like we could go out there, what you're talking about, the S&P 500, all of those top positions in the S&P 500 are in a very popular place right now. You know, people know about Google and Apple and things like that. So what we're talking about here is kind of letting your analysis hold more weight than going out there and saying, hey, what's the most popular thing I can invest in? We'll start with Reggie.
Right. I mean, you know, the old saying, nobody rings the bell at the top. And if the only basis that you have on the on investing is popularity, what somebody said, or what's had the highest return recently, you know, usually if nobody rings the bell at the top, you got to get out before the next greater fool. And with no analysis, I know I can't do it. I'm not very good at timing. And so the key, you know, popularity is really dangerous when you have no analysis behind it. And, you know, value analysis, I guess, in this world, value and growth, and you use all these things, but it's really the analysis of the asset, or in this in this case, the company or the investment, of what kind of future cash flows they're going to produce for the owners of that asset or company as a stockholder. At least there's some sort of analysis there, rather, I got a so-and-so said they've done great in this or they've done great in that. And usually by the time it becomes popular, most of the returns have already been made by the previous investors.
I'll transition to Shane, because Shane and I share, you know, some responsibilities on this. This has got to be one of the hardest things to coach an individual on. It's kind of easy for us to sit here and talk about, you know, these manias, but it's really, you get the emotions in a very powerful delivery when you're talking to a client one-on-one and they come in and say, man, my buddy's making all this money on this thing. and then slowly it becomes the most popular thing, and it could take years until you find out, that either it's not worth something, or, Enron or something like that. But any coaching skills that go along with this, trying to avoid the popular thing? And I know it's hard to do individually, but we're on a mass basis now. And any thoughts you have on that?
Too many. I don't know if I can articulate them well. And we talked a little bit about it at the last, thing we did when I gave the example of my kids. But popularity with investing usually comes really late in the cycle, like Reggie said, and that usually translates to poorer returns. It's different to be popular and something else maybe socially. I learned just even on Thanksgiving, we were sitting at a big table, we had family over, and my nephew's girlfriend was explaining what was out of date, and she basically described my wardrobe, So I was really going, of course. So yeah, I'm always, social or style wise, I'll be the last one too, but it's actually dangerous to be popular in investment world and be at the end of the cycle. And so we know that because we've seen many collapses and crashes, but it's exceptionally difficult to try to get people to believe in that, or to, be with you sometimes. I know, just as a recent local phenomenon, a friend of mine texted me and he said, I need to know everything what's going on about this coin because one of his nurses at the hospital made this extraordinary amount of money. He said, I don't even know what that one coin is. I was looking at it. And so it's been a couple of weeks, so maybe 3 months transpired, and we saw him together in the neighborhood, and he yelled out, he says, hey, I heard some people lost a lot of money on that thing, and I just kind of smiled and waved, and we never really got into it, but it was so powerful that he even came out of his own rational, Dr. Shell, and was reaching out to me saying, I need to know everything, Shane, and it just happens. They're manias, and we're all human beings, and we're susceptible to them, especially if some of our family and friends are participating and you feel like you're missing out. I think we're pretty grounded, and we hope that we can add that value for our clients, but I know it's not easy for people. But it's real and it happens.
And, that leads to the next one, because usually the popularity stems from a guru or something predicting, sharing their predictions about the future. And so what we say to kind of, go to the risk management side of things in preparing for the next storm is avoid reliance on predictions. And so, we see a lot of predictions out there, so many that it is hard to avoid them. But I'll start with Shane and share any insight on that.
If you keep with these questions, we're never going to be popular or cool, because now I'll be downer again, but honestly, the new year comes with many predictions. I think it's human nature, between the weather and the stock market and the mass media and the magazines, and there's hundreds, if not thousands of them, it's really almost inescapable, for the predictions. But I really just can't find much value in them, and certainly not to make one of my own. If you think about it, there's no real penalty for the thousands that are wrong. And every once in a while somebody gets something extraordinarily right and they get catapulted to this guru status, but that's even really short-lived. You don't see them for years often, because the graveyard's filled with a lot of one-hit wonders. So when I think of the predictions and trying to resist those things, I think of like one of the Warren Buffett quotes. He says, forecasts tell you a great deal about the forecaster, but they tell you absolutely nothing about the future, or something like that. So I have to side with Warren on that one, and just be calm during the new year and all these crazy predictions.
Great. That was a lot of great coverage. Anything to add there, Reggie?
No, just it's twofold. It's the percentages of people that get the prediction right, and then the percentages of people that actually make money off the prediction they got right. So, it's not only getting it right, but being allocated correctly, and that doesn't even happen a lot.
Right.
Yeah, so true.
Well, all right, this is our final one. As avoid choosing investments on past price charts. And so, what I had in mind is a lot of times we hear, hey man, this one's gone up a lot, it's doing well. Man, that one's dropped a lot, it's got to be at a value, let's buy it. Basically, what's missing here is an analysis of the business. And I'll start with Reggie there.
Right, it's not only the analysis of the business, but it's also the focus on the price performance of the charts. It becomes so short-sighted as well. I mean, some people, they look at, well, I mean, some of the traders look at minute charts, but even if it's a 6-month chart and people are looking at the past price performance to try to make an investment, is they don't open up the chart long enough. It's like even some of these recently, they've gone crazy on the upside, and you get this small pullback, which looks huge on a 3-month or 6-month chart. But then if you just open it up 3 or 4 years longer, you can see that it's nowhere even close. And charts, they got technicians and all these signals, but I can't make any sort of investment decision based on the chart.
Yes, I think you bring up a good point. I wasn't even thinking about when I wrote this, but the chart patterns can be deceptive by just changing something as simple as the time horizon that you chose to print that chart over. Anything there to add?
No, not really. I mean, a lot of times the charts that are open, even my standard charts that are open, don't even encompass a full business cycle. It's just a short-term quick look at things, and it's not, without any analysis, it's not really meaningful. Underneath that chart, there's a company, and there's a lot that's going on, and you need to do the analysis to understand what that is and why. But the chart alone is just like the first layer of an onion, it doesn't do much.
Right.
Yeah.
Well, I will. Sounds like a good place. We'll just kind of conclude this. I enjoyed this once again. And I'm going to give y'all each a chance to, kind of make some concluding remarks. And I'll start with Shane.
I think we covered it. Hopefully this is well received. We titled this, things to think about in preparing for the next storm. It's so much easier to prepare in advance. Once you're in it, if you haven't done the groundwork, you really don't have a lot of flexibility. And like Reggie said, we aim to provide as much flexibility and have you with as much flexibility as we can so that we can navigate them, because they will come. It's just, we just don't know exactly when. So that's it for me.
All right, Reggie, any concluding remarks?
No, I just I enjoy the dialogue and hope our audience does as well. And it's hopefully just to kind of share some insights in a quick, maybe more enjoyable way than words on paper. So hope everyone enjoyed, and we'll see you soon.
All right, we will, a little housekeeping now that you brought that up. Next time we plan to not be as Debbie Downer on this. We plan to dive into our investment themes, what things we think about in general are kind of have a long runway, not a short trading thing, but, investment themes out there for hopefully decades. And we enjoy putting together some of the material for that so far. So hopefully you can tune in next time. And, that's it. Hear from Shane and Reggie and James. So we'll see y'all later.
All right. We'll see you guys. Take care.